Good morning, everyone, and welcome back to another episode of Trade with Conviction. I'm Felipe Elink-Schuurman, and today I'm joined by Neil, Jorge, and James. Hey, guys, how are you?
Yeah, very well, thanks.
Very good, thank you.
Guys, good to have you. An exciting episode today because it's our episode 100. Now, I think that only like 3 or 5% of podcasts last 100 episodes. And I think it was last week or 2 weeks ago that we had like 1,000 listeners for one episode, which was our record. It's amazing. It's amazing. And you guys are doing an amazing job at writing the script, at coming up with all of these trade ideas. And it's fantastic. So congratulations to you. There's so many other people that are participating, like June, and most recently Abhishek, Jay, Hua, everyone in the company, and it's quite exciting to be here 100 episodes later, still providing insights and reaching new highs when it comes to audience. So fantastic work. And today we have quite an exciting episode, I have to say. There's a lot of things going on. Geopolitics is obviously still top of mind, but we're now in sort of slowly transitioning into a very choppy world of supply and demand and politics, and then back to supply and demand, and then back to politics. Whereas, over the last 3 months, it was just politics, and fundamentals were a bit like the side story. And now it's, we're getting to that transition period. But why don't you give us an update, Neil, on the Hormuz situation, then obviously Russia, and then we can go into the individual products on trade perspective.
Yeah. I'll take us through. So I guess it's fair to say we're in a sort of limbo situation now, because I think everybody can see that the news in terms of the flows out of Hormuz is pretty good. So exits and entries, they were sort of temporarily halted last week because there was a couple more attacks on vessels. But then it's restarted really quickly. And some of the numbers in terms of the million barrel per day flow coming out of Hormuz are very big. So we're getting somewhere between 10 to 15 million barrels per day, which is a lot. Now, the June average is a bit lower because we had, a slow start to the month, and then there was a pause due to the tanker attacks. But generally speaking, the numbers are very large. And so you can see now why the market is so weak at the moment. Because if you start to come up with some of the numbers, you had 10 million coming out of Hormuz, China's dropping 5 million barrels per day of imports, the US is exporting max, you got some demand weakness, you got Yanbu. And you can get your little spreadsheet and you can get back to a balanced market. And what a lot of people are talking about now is this catch-up effect, right? Which is when you try and shake the ketchup out the bottle, nothing happens, the bottleneck, and then all of a sudden all the ketchup comes out. And that's what's happening particularly on crude just now. We have this situation where we've got a pile of crude coming out of Hormuz. We've spent 3 months prior getting rid of seaborne oil demand, and China is suspect number one in that in terms of their imports. And now the market is super weak. And me personally, I'm quite surprised at how weak the market got. I think I underestimated the impact that the crude coming out of Hormuz would actually have. I'm not saying it's unjustified just now, but I think we can all agree it doesn't necessarily represent a stable situation in the market, right? As you were saying, Felipe, there's lots of moving parts. Who knows what China does? Who knows what the flows do after the MOU period finishes? But at the moment, I think we can all understand why crude is so weak, particularly physical crude.
In hindsight, it's one of those things where in hindsight, it's like obvious, you had so much oil out there, and the new dynamics and the inertia of US exporting more and more, and probably hedged the oil in advance, so they're already flooding it, and China buying less, all of these things we already knew. So in hindsight, it's like, okay, makes sense. The market is weak, and being in contango makes sense. But when you're, just before the announcement, you're like, okay, it will get weaker, but not this dramatically weaker. I think that no one puts that into a perspective of you can go from 0 to 100 so drastically, so quickly. But similarly, as it happened when the announcement when the war started, everything was completely amplified to the extremes, and jet being an example, or the regrade, and it sort of cools down. And I guess that we're in that period there where there's an exaggeration, rightly so, in terms of fundamentals. It makes sense. Now, where do you price it? Is it at this level, lower or higher? That we shall see.
Yeah. And I also personally had an excuse not to be so optimistic like the last week or two because of this notion that, owners are going to be very wary to put vessels into the strait. And therefore, what you're doing is you're effectively drawing down the floating storage that was trapped inside the Gulf. And that doesn't necessarily mean you've got like a sustainable supply normalization, right? You need the loadings, the fresh loadings to pick up. And so I was like, oh, okay, the market's going to realize that. But even the last few days, you saw the inbound traffic was picking up. You've got all these stories about actually the pace, the fresh pace of loadings also picking up. And so even that story now seems more optimistic. It doesn't mean that it won't be different in 2 weeks' time when something happens between Iran and the US. But at the moment, I think there's every reason to be, to understand why physical crude is so weak. It's slightly different on products. And James, I mean, you guys can all talk about products later. At the moment, it is just crude. I mean, a lot of the stuff coming out of Hormuz is just crude. I haven't heard too much about the status of refining inside the Gulf. So I haven't heard of loads of refinery startups, but that is probably going to come if we're normalizing crude supply. But at the moment, the margin picture is completely disconnected from the crude pictures. The margins are really, really strong. And the other thing that's going on is, where do we go from here? I think everybody's still very confused. We're in the same picture where it's difficult to be long because you're afraid of what headlines might come out. But you can see that, we've still got many open questions. What happens after the 60-day MOU period? What do Iran think they're going to do on the status of tolls? And there's lots of competing notions here. So I think it makes sense that Iran is maximizing this time period to get as much crude out as possible because they need the money, and is going, as far as I know, into floating storage in Southeast Asia, amongst other places. And from the US side, did you see that there was a clip of JD Vance on the Michael Knowles show 1 or 2 days ago, and he outright said, we're using this time period to refill the world's oil economy, and then we'll see where we're at. And I thought that actually became a bit viral because they have not said it so clearly before, and it does make you wonder, okay, this is really just the calm before the next storm from basically both sides.
Yeah, makes sense. I mean, there's still a lot of unresolved issues and question marks, as we saw already last week with, whether it's Israel and Lebanon, and also the attacks on vessels in Hormuz. We have not written the final story, the final chapter of the story, I would say.
Yeah. And another thing that's just the last point on this before I move to you, James, on Russia, because I was getting a lot more journalist questions on this throughout the week as well, is what's happening on annual balances. So a lot of agencies have now started to produce the 2027 balances, and they're all producing these huge long balance because they think supply is going to be maxed everywhere, including out of OPEC, and more supply growth from LATAM. And then they think demand is not going to be particularly strong. It's going to rebound from this year, but not that strong. And so this is probably having some impact on the price today as well. When journalists start asking you about it, it means it's a story that the market is talking about. And I think that's all pretty premature just now. We know not to trust balances for 18 months out, but I think this is premature in terms of the price today, and it isn't really something we ought to think about yet because there's so many moving parts. What do the Chinese imports do next month? That's the biggest question in the market, apart from Hormuz flow. So let's try and figure those things out before we start thinking about 2027 balances.
Yeah, and as you say, moving on to Russia, I guess the story has just been huge refinery infrastructure losses, just a real reduction in runs. The administration in Russia, Putin himself, is facing real and unprecedented military, economic and political pressure as the prolonged war in Ukraine increasingly and somewhat, I guess, surprisingly turns against him. His domestic and strategic positions have started to deteriorate, and I think there's a real risk that he thinks about escalating this conflict through hybrid warfare, even, I feel scared saying it, even nuclear threats, and acting as like a bit of a drowning man, willing to drag others down to ensure his own survival. So what are the key points there? Just a devastating military attrition. Russia is experiencing catastrophic losses, casualties reportedly exceeding 1 million. Ukrainian drone supremacy has really stepped up, so much so that the life expectancy of Russian recruits is sitting somewhere at mere days now, creating severe manpower, but also just morale issues as well. Then the economic and infrastructure could just collapse. Ukraine's highly effective deep strike drone campaign against Russia, against Russian oil refineries and depots, as well as military and industrial and civilian targets, is now really having a crippling effect. Moscow's been prioritizing protecting, I guess, as you'd expect, the city of Moscow. But this has kind of left not much protection for refineries. The Russian companies themselves have been trying to mitigate this and deal with this, but Ukraine just has a massive edge in that concern. And then all of that has really kind of triggered like a domestic crisis, really. Fuel rationing, soaring inflation, labor shortages, and kind of just desperate measures where the administration just confiscates oligarchs' assets to try and fund the war machine. Russian runs, shockingly, reportedly halved from 6 million barrels per day to something now about 3 million barrels per day. There's continuing talks of Russian bans on diesel exports and maybe even having to start importing diesel. And that's also got an effect for other fuels as well. Reports are that Russia's looking to import large gasoline volumes, perhaps in some kind of crude swap with Indian refineries. And there's reports on the jet fuel side that domestic flights are down by almost as much as 1/3. And they might need to start importing avgas or jet fuel to power these planes. And there's just a rising discontent in like the Russian zeitgeist. The crippling realities of war and the escalating economic pain are just fracturing domestic support for this war and the administration. So both ordinary Russian citizens and the elites are just growing furious with Putin's, seems like, just out of touch handling of this situation. I mean, there's talk of like a collapse in Russia akin to like 1917. I mean, just a catastrophic situation. Really, the question is, what is Putin and the administration going to do next?
I have my opinion on that, but I more of the same. I just don't see any change. It's, history tells us, whether it's in Russia or Iran or whatever, is that when you think, we're looking at this from a very Occidental kind of way, in Europe, if you don't get an extra day of holiday, everyone is outraged in the street, and so when you see these things happening in other countries, you're like, well, this is not going to last for another day, and in reality, it continues lasting, and they find ways, and it's a different political setup, and it will just continue like this. I don't see any changes happening. To the contrary, I think that there's going to be, I understand that some of what you said is alleged or it's a rumor or whatever, but if I just imagine that we'll continue with seizing assets and taking more money from other people. That's my impression. I don't think anything's going to change over the next days until you get to a point where, okay, people just say stop, like 1917, but we have a tendency to believe it's going to be always shorter or sooner than it actually is.
Yeah, they cling. Kind of alluded to there. It's having like a massive effect, probably the most on distillate, really. Global diesel and jet spreads and cracks have gained reasonably dramatically over the past week. And probably contrary to kind of the views that we've expressed over the last few weeks, to be honest. In the case of ICE Gasoil and Singapore diesel and jet, this means that spreads and cracks have moved up to seasonal maximums, only outdone by 2022. Whereas for heating oil cracks and spreads, actually they've moved up and they've outdone 2022. We're seeing them sat at their highest seasonal position for at least the last 10 years. The HOGO also remains or has moved up or remains at its widest, highest position. And the East-West on gas oil and jet have moved to their lowest seasonal position, so historically wide. All three of these have surpassed 2022. The combination of reduced Russian diesel exports, which has come on top of continuing low US diesel stocks, has been enough to outpower any kind of AG normalization of distillate exports, essentially. And for me, the kind of sign that this is the case is that the effect has been stronger on diesel than for jet. So we've seen Singapore regrade, which has actually weakened over the past week. AG normalization being more net positive for jet supply, but US and Russia being more net negative for global diesel supplies.
Makes sense.
So how does that kind of shake out into the ARBs, and let's flow into the trade calls from there as well? So US Gulf, MR, diesel and jet ARBs closed to Europe. But actually, on the flip side, AG, West Coast India, diesel and jet ARBs are open and pointing into Europe. So it's a bit of a mixed bag there. The strength in US diesel pricing, of course, has closed those, or US distillate pricing has closed those ARBs to Europe. And this has actually had a little bit of an effect of widening once more the Widowmaker, RBHO. But I'm not sure how much of a solution there is there, because the US already seems like it's running max diesel and jet yields. Gasoline needs those yields as well, right? It's unclear how much diesel yield there is to give in the US currently. Of course, the outages that we saw at Monroe Trainer Refinery over the last week or so have been important as well. And yeah, we've kind of spoken to that, but the massive width in both the jet and gasoil east-west have pointed these Middle Eastern cargoes clearly to Europe. They're sitting open. The trade calls off the back of that. US ARBs closed. Diesel yields seemingly maxed in the US, Europe, and presumably Asia as well. And continuing issues with Russian diesel exports. And as kind of Felipe alluded to, that's probably going to drag on. It feels difficult to not be short-term bullish on just global diesel pricing, really. Perhaps the improving refinery runs, exports in Asia, Middle East will be enough to cap this, but this feels more like a medium-term story. I can't see that solving it in the short term. Jet overall actually seems in a more healthy position, due again to that AG normalization. That flow is so much more important percentage-wise for jet, I guess. So I could see an argument probably to be short global jet regrades continually from here as well.
Neil, one question about that before I move on into gasoline. You were talking about exports out of the AG being fundamentally around crude, not so much products. Is there any specific reason for that?
I'm not sure, but I think the majority of the volume stuck in the Strait was crude.
Interesting.
It doesn't necessarily seem to make that much logical sense, right? Because you would think that there's a bunch of products were equally kind of trapped in there, but generally the volume of products coming out the Strait is much lower than crude, so maybe that does make sense.
Yeah,
and I think when you go, Jorge.
No, I think that's what the cracks are telling us, right? Because since the beginning we've seen a big rally in cracks, so it makes sense to that difference on crude volumes versus product volumes.
Yeah. That's a good point.
Yeah, it's just, you can track it. You can see that it's mostly crude coming out. I think that there's a bunch of refineries that haven't really restarted yet in the AG as well. And then you add in all the other sort of refining rows. You shouldn't underestimate this Russia story. It's absolutely massive. Like the fact that they might be importing all fuels, except for maybe fuel oil. I don't know about fuel oil yet. It's a crazy, crazy story.
It's a turnaround. What a turnaround, yeah.
It adds to a bunch of other stuff that's happened. You had European refineries had to run a bit lower reportedly over the last week because of the heat wave, right? You had things like Salina Cruz in Mexico blowing up. And so you're in this sort of stage where every incremental piece of bad news for supply really adds to the price because it kind of, it just adds to this whole story. So there's been a lot of bad news, so to speak, on products, whereas crude is just seeing a flood. So that's what cracks are telling us as well.
Yeah. On gasoline, there's a similar kind of story that what you were saying, James, in terms of the ARB dynamics and supply and demand dynamics, and what we're living now is sort of a consequence of what we've lived during the war.
Yeah.
In the sense that obviously the Western Hemisphere was supplying the East in a counter-seasonal or counter-ARB kind of movement. And it was the same thing in gasoline. So we ended up in a situation where the US was the sole supplier into the world or the main supplier, particularly on diesel, not so much on gasoline, as Europe also is exporting. But Europe was depleting its stocks very quickly in order to supply the East. And I'm actually, I'm proud of myself. I'm happy about it. I made a good call when I was saying, when I was quite bullish Q3 spreads and Q3 East-West. So it's actually happening. So happy about myself here. I want to just say it. But now the point being is that was the point. That was the point, is that you were emptying stocks. And we're now seeing that the bullishness that we're seeing on spreads, particularly in not so much in Asia, but mostly around RBOB and EBOB, is supported as well on the physical side. When you look at reformate prices in Europe, they keep going up. So this is not just a speculative kind of positioning. It's also a fundamental situation here where you see the cash dips. Now, obviously, the reformate is also going up in line with gas naphtha. So there's an alignment there. But when you see, obviously, we had a very strong window yesterday on the first day of July. Today, again, EBOB spreads now at $51 when they were at 30 not long ago. So there's a very strong momentum going on for sure. And so I would suspect that this will continue throughout July. And one thing to keep an eye on is that blending margin of E5 or E10. And that's the first thing I looked at this morning following the bullishness on the spreads from the front month. And what you can see is that it's still closed. You're still having negative blending economics. So mostly on the back of cash diffs following this rally. So as a consequence, you don't have that potential pressure to sell in the window. And again, it just confirms that there is a fundamental story here. And for me, the one to watch. So for me, it's just, the trend is your friend. Continue with this. Even though we're now at 10-year highs, James, you were talking about 10-year highs. And let's not forget that, we also had the Russian crisis, within those 10 years. So we're already exceeding that.
Yes.
Same with gasoline. Obviously, the gasoline story. So the trend is there. The trend is there. I would continue with this trend. It's tempting to say, well, East-West at -13 is sort of the bottom. But we're also seeing some ARBs open or theoretically open from AG in Singapore into WAF. But at the same time, we also know that Dangote is producing at max, so that probably the volumes going to WAF are going to be limited. We do see that Singapore and the East is now the cheapest source of supply into places like West Coast Mexico, Ecuador, etc. But again, even Brazil, we noticed that Brazil was now from AG. But again, these are not massive volumes. And you combine that with the fact that we were emptying stocks and we're now at extremely low stock situation in both in Pad 1, Pad 3, lowest seasonal levels in 10 years. The ARBs, I think that the US or Pad 1 will need those ARB movements. When you had this uncertainty during the crisis, what we saw is that the stock levels were coming off, but everyone was buying just the minimum requirement because no one wanted to buy too much, at these kind of levels, so people were just buying the absolute minimum quantity they needed. And I think this is going to happen again now with these, you see the RBOB swaps spreads, very high. There's going to be a little bit I can expect that when you look at the ARB margins from ARA to New York, it's going to be open for 2, 3, 4 days. People lock it in and then it closes again, but you're going to need that supply for sure. And that's just going to maintain the momentum. I still see that ARA is the cheapest source of supply into places like Mexico or Canada, which again is telling you a story that this is demand driven. It's a pull, not a push. It is, in my opinion, seems speculative when you see the rally, but actually there is fundamental story there. So bottom line, I think that the trend is your friend. You should continue with this position. Keep an eye on blending margins in ARA. If you see that the ARB start shutting down from ARA into these destinations that I was mentioning, or if the blend margins become positive, then that's sort of the first sign. I don't think that Singapore and AG supplying the West is going to be enough to sort of cap that momentum. So yeah, good days for the bull traders right now, and I think it just continues. Yeah, maybe not as accelerated, and of course there's going to be some dips. But if there are some dips, seems like a buy.
Okay, yeah. So I agree with it. Maybe we can link it with NAFTA because I think NAFTA movements are right now very connected to the gasoline market. And I would like to start with East-West, since we have seen the same trend than in gasoline, but the level where we are, mainly for August contract and onwards, is completely different. We have seen NAFTA East-West above 100 and steady around $70 per metric ton for months. Right now, we have seen a huge correction, but we are at historical average. It's trading at plus 18. So despite the huge correction, it is doing what it normally does, or showing the premium for the Eastern market that it usually shows. And right now it's clear, the middle of last month, Asia don't need Western product as it did during the beginning of the crisis in Hormuz. And we are seeing the ARB close and the cash diff negative in Asia. They have climbed a little bit in the last sessions, but they remain negative, and they have been there for 2 weeks. And we have a very clear sign up according to the ARB economics. So right now, Algerian barrels, one of the main switching barrels, is pointing on an MR to Northwest Europe rather than bigger vessels into the Asian market. Yeah, then if we look at the Northwest Europe market, is where it's more linked to gasoline, and the picture is completely different. So we have seen recent pulling from the blending side for NAFTA, and gas diffs have rallied. They have rallied for open spec NAFTA, but they have mainly rallied for blending gasoline qualities. So for LBN, we are seeing a very strong market. As Felipe has said, right now we are seeing the ARB closing to Pad 1, but it's something that will keep changing probably during the summer. And we have seen it open, so that has requested more demand for NAFTA. Also the ARB to Brazil, which has a very strong content of NAFTA. And this has been the main factor that has been supportive for the Northwest Europe NAFTA market, and that have closed the ARB into the east. And then if we look at the ARB picture, I think this is one conversation that we are having right now with a lot of clients. We have seen a very ARB an art that is very, very weird on the naphtha market, which is Red Sea going directly into Northwest Europe. We have seen the ARB open, and it remains open for the second half of next month. And it has traded. At least one cargo was confirmed doing this route. This is something that shows very well the current situations and the strength that we are seeing in Northwest Europe. And then another one that is more common, but we have seen it during this period again also, is US Gulf Coast into Northwest Europe. From 4 to 6 cargos, we have seen the ARB open. Right now it's closed, but there will be probably more opportunities. But in the coming weeks, I think this could be enough at the moment. So naphtha market is very strong premiums on the blending side. But maybe all of this ARB that has been closed when the product lands into Northwest Europe will give some pressure into the Northwest Europe market. So the ceiling to the current uptrend could be close. Then also one piece of news which is very relevant right now in the market is South Korea. They have banned the exports of naphtha since the beginning of the war, and right now they're gonna probably lift this ban. So we've been looking at the volumes, and we still think that it's relevant because South Korea exports naphtha mainly to Singapore, some other outlets like Indonesia and so on. But if you compare the levels with the potential level that could be or should be reached again by AG, it's just at 10% on a monthly basis. So I think despite this a relevant news, the eye should keep on our move levels. It's going to be much more relevant. The pace at that the AG will be rising their exports than the incremental supply that could arise from South Korea. And I think this is all for naphtha. We can see a couple points on LPG. So it's a market very dependent on AG. Right now we are seeing it easing since the almost reopening, and we have seen it in Saudi Arabia selling prices, official selling prices monthly. They have posted another decrease. We saw it 2 days ago. And also US, which has been the marginal supplier, the one covering the lack of AG supply during all this period. The inventories are building, and we are 60% above the 5 years average. The market or the balance in the US is also telling us that there could be more bearishness on the LPG market. And if you link both the stories, I think that the propane one will be stronger. So we could see at the current levels of propane naphtha, we could see it correcting in the coming weeks or months. And yeah, I think we can jump now into crude news.
Crude. Where do I start? I think I have to say on physical crude, like I think I was saying at the start, I'm a bit surprised by how weak it got since the MOU. So I think when we first got confirmation of the MOU, I wrote in one of our pieces that there would be some stranded crude cargoes coming out the AG. But I thought that's where it would stay. But what it's actually done is helped to drag every single physical crude diff in the world way lower. I didn't really expect that. I do think there's an element of the paper is dragging us down. So obviously paper is super weak. We're in contango and it doesn't necessarily reflect the physical situation always, right? Because you have a big sell-off in paper crude, you've got the trend followers getting in, you've got the longs getting completely battered again, and automatically filters through to some of the diffs, right? It's basically a technical thing. And there's even ways of accounting for that, right? In Brent, there's something called the dated to lead, which I think is the DFL minus the M2, M3 Brent spread, which I need to look at again. I've not looked at that in a while. But there's a certain element of the paper is filtering through to the physical. And like I was saying, I don't think there's a stable system. But what we have just now is, the physical is getting absolutely battered. And one of the ones is Brent. It's very weak. We've had fees, which is, I guess, one of the physical benchmarks at discounts to dated. What that has done is close off the TI ARBs. So it's not just the AFRA. It's things like the VLCC, Suez AFRA for TI into Europe is very close. WAF is super weak. So the sort of main one leading the charge in terms of the month-to-month decline in the physical diffs is Angolan stuff, which you typically associate with China as well. And a part of that is, you actually have a bunch of AG crude cargoes coming to Europe. So it's something that we said 1 or 2 weeks ago again. If China's not buying, if Asia's not buying because they've got their crude slates covered for the next 2 months, then you're going to have some AG crude going to Europe. And increasingly that's the case. You get a few more cargoes heading to Europe over the last week. Some is going to the US. It's going as far afield as things like California, as far as I know. So all that is really putting pressure on the Brent complex. And like I say, the thing that's happening just now is The TI arb is now closed to Europe again. And if you guys recall, I've been saying that for at least 8 weeks. This is what needs to happen because you're still drawing US crude. It was the crude of last resort to go to Asia, and now we're closing it off. And actually, TI is also closed into Asia relative to things like Murban and stuff like that. So it's doing its job, right? And it's just being exacerbated by physical weakness in the rest of the world, which I didn't really expect. And it's the same story in the AG. So Dubai swap spreads are still very negative. They're in contango. You've got this mini glut coming out the AG. Would need to change to reverse that. I think in the very short term, would have to be some evidence that something's happened in Hormuz. Otherwise, I think it's kind of status quo just now. And beyond that, the next thing to watch out is the next couple of Asian cycles, because we've spent 3 months convincing Asia to either reduce their imports, to call for SPR crude, or to take Mexican, US, West Coast Canada, LATAM additionally. And I think what we need to see is that the Middle Eastern crude is cheap enough to tempt the Asians back, and that is going to happen in the next 1 or 2 trade cycles. The next one is going to start in 2 weeks, so we need to wait for that. And then I think we will see South Koreans, the Japanese, taking more and more spot AG cargoes. And I actually heard this morning Chinese independent refineries were heard talking or taking spot Saudi barrels and spot UAE barrels. So I think this thing will clear. It doesn't necessarily mean the global balance changes, but I think the slate will start to change again because the AG is going to be cheap and they're going to want to tempt the buyers back. And so that means for things like the upcoming OSPs, those are going to be relatively cheap. For the next round of spot tenders that starts in 2 weeks from Qatar, things like Al Shaheen, those are going to end up looking pretty weak as well. And I think that's the rebalancing mechanism. So I actually kind of think we're at almost peak weakness at the moment. And that's from the sort of very micro perspective, but also from the macro perspective in terms of weakness, which is where I've got 2 trade ideas this week. One is a very general one, and I don't even want to call it a proper trade idea because I don't know the timing. I think we're at our weakest possible point just now because we have the longs have been battered, the paper has collapsed, and all the solutions look great. You had max US crude and oil product exports. By the way, those look much lower over the last month because they have to be, because the US oil stocks are low. You had Chinese imports, which were at their lowest that they could possibly go. You've now got flow out of Hormuz. You've even got SPR barrels that are still coming to the market. So all those things have come together, and that is about as weak as we can make this thing. And so I think from a very general perspective, you can only have things going wrong now. And so I think we're from a general perspective, because people are asking, also journalists are asking, do you think our prices are going to stay this low? I think no. I think they will start to rise again. From a very short-term perspective, the one I feel most comfortable talking about again is TI Brent. So like I was saying at the start of this, TI Brent has done its job now. And you saw that also materialize in the MEH spreads. Those are the spreads between the US Gulf Coast and Cushing. And those went negative. And now we had our first build at Cushing last week. Because of that, it started to solve itself. And TI Brent, from that perspective, is also doing enough. Like I say, it's closed off most of the WTI ARBs to a lot of locations around the world. We're seeing the US crude exports drop away, which is what we need to happen. And we see freight actually getting a bit more expensive to come out to the US as well. So certainly V's and Suez look a bit pricier. TD25, we're starting to see the vessel availability in the Gulf Coast and in WAF, by the way, move lower. So it looks like freight will start to rise. This makes sense to us because we need to have more ballasters going into the Middle East. And from the geopolitical side, I think the risk is on Brent spiking as well. So all these things for me mean that TI Brent is no longer a long. It might even be becoming a short relatively soon. So I'm going to go short TI Brent over the next 2 weeks, let's say.
Okay.
I think that you made a good point on saying it's just doing the job. Let's just put things into context. TI was the supplier to the world and WAF and all that, and now it's the other way around. And let's not forget that we were emptying stocks at high speed. For me, the question, so this whole movement of, I think you mentioned here, Murban is open to Europe. I think that and you put open in brackets in the sense of it's a push. It's like I need to get rid of this oil. I need to go somewhere. And Europe is right now the best destination, but it's not officially open. It's just the best out of my options, And also because of the shorter procurement cycle, no, relative to other places. But I understand there's also open, or in the same way, open in brackets to the US. And so the question, so I go back to what you said. All of this makes tremendous amount of sense. Now, the question very much is, what's the bottom? And you're saying we're at the max weakness. And to me, the moment that I would be able to say, you know what, let's put aside the war, okay, because tomorrow Trump can do something or Iran can do something else, but let's just assume that things continue as they are right now. For me, the critical point is, when do we start replenishing those stocks? I don't see anyone starting to do that right now. I think that, psychologically, you need a couple of more months of stability and things like that before you even consider buying back stocks. That for me is the sort of the moment where you can safely say, okay, this is, we can go back up on a trend basis, not on choppy basis, but on a trend. Yeah. Now, can we touch the floor now, bounce back, and then go back down? Perhaps. I think that we're now entering into that phase of moving up and down, within a range. But the moment that you can actually say, okay, now we're hitting a real ceiling or hitting floor, is that, okay, when do they start buying, or when do they start replenishing those stocks, I would say.
Yeah. Are you talking about SPR or everything, SPR and commercial?
Commercial, but mostly SPR, China, all of this, At some point, if you empty the SPRs, you need to replenish them at some point, so.
Yeah. And from that perspective, it also makes sense I doubt that OECD Western governments are going to go into the market in a big way for SPR barrels just now to buy back. I think that makes perfect sense. But the most intriguing question in this whole affair at the moment is, what is China doing? Yeah. That's been almost the biggest buffer in the whole of this story. And no one really truly understands why. And there's these two camps, one being that it's strategic and one being that it's, purely price driven. And you have to remember that when Chinese imports officially dropped to 6 million barrels per day in May, those barrels were bought in March, or not all of them in March, but many of them. And now we're at a price of $72, and that historically has been the price that China has wanted to fill their barrels or fill their storage with. And so it's quite possible that we start to see in a few weeks' time, the cargoes with destination China starting to rise again. And then the official import numbers in, let's say, August, September, look quite different to us. And we'll be sitting here in 2 months going, hey, look, the price was really low and Chinese started buying again. And it's the biggest question in the market, when are they going to come back? Because that's the main thing that will drive the physical crude market higher, and probably also drive flat price as well, unless something drastically has changed in Hormuz.
Yeah. And just before we leave, both James and I had a similar kind of view on gasoline and diesel, similar stories, similar kind of fundamental dynamics. Yeah. But the problem here that I see, and it's at some point something needs to, it cannot continue like this. You cannot have a very weak contango crude market and at the same time a very strong diesel gasoline. At the end of the day, the crude structure always influences to a certain extent the product structures. Now, you can exacerbate that, and we're now at that 10-year high on cracks and on spreads, etc. I'm just rethinking what I was saying before about, for the short term, and I would say for the next 1, 2, 3 weeks, the story remains, the trend is your friend, but this cannot continue too long. At some point, that weakness will be translated into the products, I would say, or not, or actually, as you're saying. For me, that's the interesting trade that we need to think about. What is the positioning? That crack level, is that going to be collapsing because crude starts bouncing back on the back of the demand of gasoline and diesel, or the other way around? Because there is, fundamentally a story of demand of gasoline and diesel. Both of them are a pull, not a push. But I don't feel right with it. I don't know what is the strategy, but that's something that, makes me nervous.
Yeah, and there's three things to that as well, just to add. They can disconnect if there's not enough refining capacity. Yeah. And I think that's the stage that we're partly at that stage just now, because we have AG refining capacity, some of which is a bit broken, some of which will come back. We have Russian refining capacity that's getting pummeled, and we've got no evidence to suggest that the Ukrainians will stop doing this. They've massively ramped up their missile systems. They're just going to go for it. That's what they're gunning for. And then on the other hand, you've got Chinese product exports, which are still a bit low, but they're telling us they're likely to export more next month. So that's an interesting signal. Plus, we know from some of the national statistics that actually some countries had very poor end user demand when prices were high. So they will also come back. So you've got a lot
Yep.
of moving parts, and I'm not quite sure where I stand with it, but I think we need, in order for cracks to come down, we now need quite a bit of good news. And that means Russia comes back a bit, AG refineries start to ramp up, and we see more products coming out the AG, the Chinese start to export. So you need all those things to happen, I think, before cracks will feel comfortable to sink, really dive.
And if the capacity has halved in Russia, I mean, with all the sanctions in place and all that, how easily will it be to repair those refineries?
Yeah, that's a big question. And where do they get the parts from? Because obviously all the sanctions are coming in, and there was always talk about getting Chinese help on that matter. It's not my area of expertise, but certainly
You're not
difficult.
import export between China and Russia. You're not you're not the
No, not yet, but if I need to be.
disappointing, Neil.
But I think the bigger question is, can they repair it fast enough?
Interesting times. So yeah, maybe we have a new dynamic that people did not anticipate now with that. Well, I mean, obviously the bullishness on cracks and things like that was expected, but this level of bullishness has been exacerbated by the Russian story, which seems to be a long-lasting one from what I'm gathering here. So all of those statistical relevant numbers of 10-year highs and things like that are theoretically a ceiling can actually just not be that much of a ceiling based on the fundamental story. But anyway, something to monitor. Episode 100, guys. Very exciting. Thank you so much. Thank you, everyone that is listening. We're excited to continue to 100 more. And thank you very much, guys, for everything you've done.
Thank you very much.
Take care.